you really need to consider the Wellesley Income Fund, especially if you're right in that retirement red zone, like 2 to 3 years within retirement. You know, like you're 60 years old, you're going to retire at 62, or you're 60 years old, you just retired at 58. You really need to be thinking about this. Now we're going to go into this a little bit. I've got some spreadsheets here. Well, you can't see it, but I got some spreadsheets I'm going to share with you in terms of numbers. All right, so my issue is I am not convinced that like who's I reading? A couple people are very. It was my man John Pugliano from Wellsteading podcast, and Brian Westbury over at First Trust, and both are more optimistic than me. I'm John Pugliano is surprised how optimistic he is. It's odd to me, and it's fine. No one knows. Westbury is typically an optimistic guy. Man, you can't say that. I mean, you can say it. It just doesn't make sense when you have this huge draconian lockdown, the likes we haven't seen since World War II. And that was only for Japanese people, maybe some Italians, Germans, but I mean, obviously had rations and things like that. But we haven't seen anything like this in terms of the economy. And I don't. It's with small businesses going under left and right, just struggling to survive. It's insane. I don't know how the economy just magically, perks itself up. I frankly, I don't understand. It's weird to me. I don't know. I just don't get it. I'm sitting there. I'm trying to hear the reasons that the economy will survive without a significant fall down, and I don't see it, man. And a stimulus package, whatever. I mean, it'll help put food on the table, but it's not going to do anything. If you don't have work, you don't have consumption. If you don't have consumption, the GDP can't grow. Now, I grant you that there are some areas of the market, the stock market, the investment world, that will do fine. What those are, I guess Amazon, but hasn't that already been kind of priced into it? I don't know. It just seems to me that this kind of draconian shutdown that we've been going into a year, it doesn't just one day pick itself off its back and say, okay, open up the stores, get everything's good. Now, I grant you, there are many companies that did well, thrived. There's many companies, and the guy who put my pool in, those guys are busy as freaking could be. The guy who's doing we're looking at get a generator, busy as can be. But for every one of those guys, we have other people that are just getting swamped, and that is, I don't know if I have my Bastiat here, but that is the seen and unseen. Frederick Bastiat right here. You see people making money. The reason they're making money is because they're pulling the consumption from other places. So the broken window theory is I needed my window fixed. I had a window, and now I don't. It got broken, and I need a new window. And such, the guy who makes the windows is loving it because he's like, okay, I'll fix it. And the idea, Keynesians would say, that creates economic demand. The problem is what you don't see that I no longer can afford to buy a new suit. So the tailor is being pushed out. The window maker is doing great. The tailor is being pushed out. That's not a growing economic pie. That's a pie that says we're not going to expand the pie. The pie is fixed, and the window guy is going to get 2 slices. The tailor doesn't get any. In a true capitalistic market, we have an expanding pie. Anyway, so let's go into Wellington, and we're just going to go to my man right here, and this is 55E. I had his website up here. Let me bring up his website real quick. Oh, and before you forget, follow me on MeWe. So I'm on WeE, right? MeWe, and I'm under just Josh Scanlon. You can follow me there. There I am, Josh Scanlon on MeWe. Follow me on Parler, and you can see there I am on Parler. At Scanlon is just at. The @ Scanlon is me. And so you follow me on there before you forget. So let's go into my man. Let's go. I tell you, hold on a second. Let me show you his website. I can't tell you how many requests I get for spreadsheets, and I don't have mine. I just use this guy's spreadsheets, man. So get 55e.co is Daniel Kuhlberg. Big fan. So get his stuff. All right. So we're going to use his spreadsheets. And what I've done here, this is the bucket strategy. And what we're going to do is we're going to go to the Wellesley, which is VWINX. And Wellesley was founded in 1971, if memory serves. All right. So what we're going to do, we're not even doing 2 buckets. We're just doing 1 bucket. So the second bucket, we see reserve bucket is nothing. All right, there's 0 balance in there. So everything is in the Wellesley. So you can see this is the 10-year Treasury going back to however long it goes back. In this case, Wellesley is just 1971. So we're using the Wellesley Income Fund. We're having $100,000 in here. And what we're going to do is we're going to take 5% a year. So we're going to $5,000 a year, and we're going to adjust it with inflation. You can see that changed to 5% right there. Did you see that? So if we go here, it's going to say 0. We go there, we go 5,000. All right. So what we're doing here is we're saying, look, the Wellesley Income Fund. Again, if we to remind you what it is, if you go to Wellesley, it's a conservative allocation. Basically 2/3 to bonds, 1/3 to stocks. Let's see, yeah, right here. 40-60, 40% stocks, 50-60% bonds, 63 billion in assets. So it's a big, large fund. All right, most of the stocks are going to be large cap value stocks. So you see Verizon, Procter and Gamble, Bank of America, Johnson Johnson, whatnot. All right, so and that's, I think the bonds are all they give us a credit quality. I don't see a credit quality on there, but 63 stocks and 1,100 bonds, almost 1,200 bonds. So this is a pretty diverse portfolio in terms of the bonds that it has. The fees are 23 basis points, so very cheap fund. All right, so why I'm doing this for is that because I want to see what this did when interest rates were up in the 70s. All right, now I don't expect interest rates to go up at all. Why I'm doing this, because I know, I've written my book on the Wellington Fund right here, Retire on the Wellington Fund. I know that conservative accounts, bond heavy, did just fine during deflationary times. So the 1930s, the Wellington Fund did fine, bonds did fine, Wellesley, if it was around, did fine. But we don't, during inflationary times, those funds got smoked. It's just all there is to it. Inflationary times, the bond heavy funds got smoked. I don't expect us to go to inflationary times, but I do think we're going to a Japan light, and as such, then Wellesley looks even good. It looks even better because it's heavy on the fixed income stuff. In a deflationary time, or even very low inflation, bonds look good. But the question that comes to mind is, so I'm convinced if we go to a deflationary, low inflation time, your fixed income stuff will do just fine. What if we go to high inflation with an increasing interest rates, though? All right, I was just at a rally today on behalf of our 2 Georgia senators who are running for re-election. So what if we go to an inflationary time? Because that's always the concern you have. Anytime you have fixed income, you're concerned with inflation. You're not concerned with deflation. You're concerned with inflation, especially increasing interest rates, because increasing interest rates, the seesaw of fixed income. Interest rates go up, price of the bonds go down. That's just the way it works, man. So now Wellesley doesn't have a long track record enough to go back to 1930s, the Great Depression. It doesn't matter to me, because if you were heavy in fixed income, you did just fine during the Great Depression. How did it do during 1970s when we had increasing interest because increasing inflation? Well, it's pretty interesting. I'm going to show you what I did here. So we have $100,000 in Wellesley. We're taking $5,000 a year as 5%. We're adjusting it with inflation. And what happened? Well, if we started in 1970, we never ran out of money. In fact, we withdrew totally $412,000, and we still had $219,000 left. I hope that makes sense. So you can see over a 30-year time frame, I'm using 30 years, by the way, we never ran out of money. And you can see right here, here's an annual withdrawals going up, pretty fast because of inflation. And yet here's the account balance. And here, right here, we hit 1982. As long as we hit 1982 with money, we were golden. Shoops. So we're fine. All right, so that looks pretty good. What if we go to 1973, though? Because 73, we had the markets begin to really tumble. 1973, we never ran out of money. 5% a year with Wellesley, never ran out of money. $416,000 that we took out, we still left with $30,814 when we died. Now you can see the inflation really started. I mean, you can see it's up to the Northeast. I mean, it's a huge inflation. Because in the 1970s, if you look at inflation, you're going to see right there, inflation 6.2, 11, 9, 5, 6, 7, 11, 13, 10, 6. See what I'm saying? So inflation began to rear its ugly head. But again, because we had money right there in the 1982, it and then it basically leveled off from then on, and then our inflation, the inflation was so high that the portfolio wasn't able to put more money in. It was actually just keeping, basically what was happening. Our income we were receiving off the portfolio was being gobbled up and by the amount of inflation adjusted returns. It doesn't matter. We still had money after 30 years in 1973. That's huge. I cannot stress how that's huge. Yes, we would have ran out of money 1 year later, most likely. Let's take a look. So we were taking withdrawal come 19, what year is this? 2002. We were taking out 21,000 and we only had 30,000 left. So 2 more years we would have ran out of money. I can't stress how important this Illinois is right here, though. In 1973, all right, so watch. Look at this. We started with horrific years in the S&P 500, but not horrific years in Wellesley, 3.5, 6.5. Fast forward till 2000, which is going to be right here, and Wellesley actually did just fine. Look at that. 1999 didn't do it great, but you see, it's the sequence of return risk. It didn't affect us in the Wellesley, even with the high inflation. Isn't that interesting? I think it is. I think there's a lot to be said with that. Anyway, so I did the same thing. I did it every single year, and not one time at 5% did we ever run out of money. Not one time. It's again, we only have a 1970 to now track record, so we don't have a huge amount of time, but not one time. I can't stress how I find that to be incredibly important. So what if we did, I don't know, let's see, what if we did 1990, just for simplicity? All right, 1990, right there. All right, here, not only did we not run out of money, we left a significant amount left, $400,000. So 1990 to 2000, 2000, 2010, 2010 to 2020. And you can see, I mean, we had bad in 94, 99, 2008, and I think 2018. I mean, that's just not huge rates of return, but we missed the run up of the bonds from 1982 because 1982, the interest rates were 15.5 and they just started falling. So that meant the bond market just was freaking loving life. We missed a good amount of that, but you can still see that Wellesley still did great. I just find it interesting too. The year after it got lost, so 94 was down 4.5, and the next year is up 28.9. 99 it was down 4, and the next year is up 16.2. Isn't that crazy? 2018 was down 2 and 6. The next year is up 16.4. So what has historically happened with bonds? So it has one bad year, the next year goes up. I find that incredibly important and interesting. So if we do 6% a year, so let's do 6% a year even. And now we're going to go to 1973 because that's when the market started getting killed. And we did run out of money, but we ran out of money in year 19 at 6% a year. So even after 19 years, we still had money, and there it is, just fell off a cliff. Because we ran out right there in 1991. All right, so that's but no one's really advocating 6% a year adjusted with inflation. What if we do 5,500? We ran out of money here in year 25. In 1973, probably the worst year to retire, other than, probably the worst year to retire other than 2000. And that's if you're heavy in growth stocks. But still, 25 years, you had money. 25 years. The vast majority of us aren't going to live 25 years in retirement. What if we did 1990? That's a 6%. Oh, that's 5,500, excuse me. And we still had money in 1990. What if we did 6%? We still had money. I did 6%. We only ran out of money 5 times of Wellesley at 6% withdrawal rates. And that's without even just common sense. Tighten your belt, the idea that your spending is going to go down. I sit there and I say, So let's go to Wellington Fund. And let's go to 1973. And I just simply can't remember, 5,000. Wellington Fund in 1973 did not run out of money either if we took 5,000 out. So here we took Wellington Fund with no reserve bucket. It didn't run out of money either. All right, so that's good to know, man. It's good to know. So what does that tell me? That tells me it's almost like the barbell with the Wellington and the Wellesley works great. But what if we did a barbell approach? So here we're going to do 20. We're going to do 4 years here, and we're going to do yeah, right there. So we're going to start the okay, good. So here, if we do 4 years at 5%, starting in 1973, we ran out of money. You see that? So Wellington, the barbell and the inflationary years hurt us bad because we got cash. So we got cash in here as 20% of the portfolio. That's only at 5% a year. Man, I tell you, I just been thinking about this a lot. I'm like, eesh. So the Wellesley did not run out of money. The Wellesley is 40-60. The Wellington did not run out of money either, but the Wellington is 66-35, 34. Yeah, 65-35 roughly. But the barbell with the Wellington did. I tell you, man, that's so that's the issue. If you're going to use a barbell, it's a tough one. I mean, the barbell, if we go, but this is inflationary years, high inflation. I don't think that's what we're going to. Let's just do, instead of the Wellington, let's use the SP 500 with a barbell. Oh yeah, we don't have VWINX. That'd be 1976. So what's our proxy then? Can we just do S&P? Yeah, right there. Yeah, so even S&P 500, but even, that's at 5%. But see, that's where the barbell kills us during the inflation, but during the deflationary times. So let's go back to the Wellington fund, and we're gonna go back to 1930-29. 19. I guess we can't go. Right, and we're gonna go. Yeah, there we go. And so I'm saying, look, 1929. The worst markets, we had deflation, and we're taking 5% a year out. Wellington fund, the 10-year Treasury, the markets you lasted 30 years. Even during 1929, we had deflation the first 10 years, but you got smoked. Watch the returns: -21, -26, -1, 2. The first 3 years out the gate. So this would probably be more like our Japanese, like what we could expect. Deflation with huge returns get smoked. I would think the 1929 scenario would be more like what we can expect. Not much inflation, pretty significant negative returns. And if so, Wellington did fine. What if you did not have the barbell? I think the Wellington, actually, I don't think it did as well. Let's take a look. Oops, 5,000, excuse me. Put the wrong thing in there. And let's go to 0 here. Yeah, ran out of money. So that's where the barbell comes in handy. I tell you, man. So what I'm saying is, at the end of the day, I don't think we're going to a 1970 style economy. I think we're more likely going to a 1930 style economy. And that doesn't mean a Great Depression, but it does mean you can't have too much. You can't have too much sequence of return risk, like what happened to Wellington in 1929, unless you have a barbell. Or the way around that is just by Wellesley, because Wellesley essentially is a barbell like that with 40% stocks, 6% fixed income. That just seems to me the safest bet. And look, if you're wrong, Wellesley still did well, man. It still did well. I mean, it had a good track record. It doesn't going to give the returns of Wellington, never mind the S&P 500, but protection is key. In those first couple of years, right around the retirement time, Wellesley just looks more and more attractive. I cannot be convinced, and I'm not trying to be a nervous Nelly. I just sit there and say, it doesn't make sense. The chaos in the economy it's not just here either, it's worldwide. No, that'll be your thoughts. Thanks now.